Hi everyone, hope you're all doing well, and today I'm talking about the three companies that I bought last week. So these are the three US companies that I bought last week. I'll kind of do a bit of a brief take on why I bought these companies. I have a full video on all three of these companies on the channel, which is like 20 plus minutes long. If you want a bit more of a deep dive into them, today is just going to be a quick overlook on why I bought them in particular. And I did buy a new UK company. I'll probably talk about that one tomorrow in particular and give that its own video. But yeah, I'll go through the three US stocks that I just bought last week. And as always, if you do want to know when I'm buying or selling these companies in real time, make sure you join the Patreon so you guys on the Patreon already know which three stocks these are going to be. And as well, in there's 600 Discord members to talk to. There's 2 exclusive videos a week on there that have no adverts in, and plenty of other good stuff as well. And as always, smash the like button and we'll take a look. So number one is Corsair. I'm sure this isn't a surprise to anyone. As you guys know, this is a stock that I have been buying quite a bit recently. It's a stock that I've been considering trying to break into maybe them top 3 biggest positions, because realistically when I look at this one, it's a very profitable company now. It has very limited risk on the downside and plenty of upside as well. And because I kind of look at the risk to reward on this one and think the reward is very good, and realistically the risk on this one, because of the valuation it is at, is very low, and that's why I'm really considering buying a lot of this, and I have been buying a lot of this, and it's also why I'm considering making it a top 3 position. The Corsair Gaming is currently trading at $28. Now it did recently come onto the stock market around September time, so it's about a year ago since it IPO'd now, and what I like to do is with a lot of IPOs is add them to a watch list, see what happens. And normally what happens with a lot of IPOs, you kind of get this initial like hype of them going up, and that's what happened to it. And we peaked out about $45 in February time, and then since then the stock has kind of been downtrending, and we're down 38% from 52 highs on the 5th of February. Now over the last kind of 6 months we have been kind of downtrending, which is great because I have been able to build a nice big position in this one, average down and pretty much break even on this one now. And you can see here we are starting to have a little bit of a bounce here. Whether or not that will lead to something in an uptrend, we'll see, but I'm not too bothered because obviously I'm investing in this for a long term over the course of a 2 to 5 year period. And like I say, I think I can at least get 100% return on this one. Potentially I could see up to a 200% return on this one. So it's good to have it already on a discount. It is currently a 2.6 billion market cap and the P ratio is 17. Now, if you don't know what Corsair does, it has a lot of different brands, and a lot of these brands are gaming gear, streaming gear, PC components, gaming PCs, software. There's a lot of different products they do, and they keep expanding the products that they do. And the thing is gaming's growing huge, streaming's growing huge, and one of the big things that people kind of said about this company is that, oh, it's only a CV stock, it's only going to do well in CV, and I totally disagree. I think gaming gear is going to be huge over the next few years. I think PC gaming, streaming, everyone that is basically, I would say, under the age of under 30 at the moment, have a total different view to what I would say that everyone over 30 would say. I think maybe even a little bit younger than that actually, is that, you know, gaming now has come to a point of view where it is mainstream, it is popular, it's cool to have a very expensive headset, you know, a really nice keyboard and really nice mouse, a fast running PC, and as well as that, a lot of these gaming keyboards and mices, they're not just for streamers and gamers. Like, a lot of people are working at home, and more people that are working at home are putting more money into the best products they have. Not many people now that work at home have a, you know, £5 keyboard from Argos or a £5 mouse from Argos. People that are on their PCs more want to have the best gear to use, even if it's not for gaming. And sometimes it's not even just because of the use, it's just for the comfort. You know, I always use gaming mouses, and I use gaming mouses while editing a lot of my videos. Don't use it for gaming, but I just think it's such a better product for even that, and a lot of people have that concept as well. So yeah, it's not even like a small category here. You've got, you know, the esports, streaming, gaming, work at home, a massive growth sector. So as well as the IPO and kind of having the hype into the IPO and then falling off a cliff, obviously there's a little bit of this kind of, people think that this is only a CV stock. So you got the IPO drop off, and also the combination of, oh, it's only done very good financials because of the CV situation, which I totally disagree with. I think Corsair will do very well every single year, and is not just a CV stock, and that's why I'm buying this one. And if we go into the recent Q2s as well, the recent Q2 was very impressive. So for a company that was apparently supposed to be only a CV stock, they did some really good profit again. Their revenue was up 24%, and let's not forget, this was on Q2. This had very hard numbers to beat, and it grew 24%. And a revenue company at 24%, I'll tell you something, doesn't trade at a 17p ratio. When you're growing revenue at 24%, you are going to have or demand a P ratio of 30, 40p ratio because you have growth. Growth is worth more than no growth, and companies that have more growth will trade at more of a premium. You know, the average stock that has a growth rate of 3%, 4%. Those are the sort of companies that trade around a 17p ratio, a 20p ratio. Those are the sort of companies that trade at them top prices, not a company that's just put in them earnings. A company that's put 24% year over year growth over very hard comparisons as well. And this was a quarter where there was a few problems for Corsair. There was a few problems with a semiconductor shortage that I'm sure you've seen. A lot of problems with inflated shipping costs as well. So if it wasn't for these problems as well, this revenue beat and this profit beat probably would have been even more. So that's what you got to consider as well, is because them little things that affected them in the short term aren't going to be around here for long term. So yeah, with that considering as well, I think this is going to be a fantastic company in the next few years. And once again, going back to the analyst forecast, you can see here, analysts are currently now predicting 20% growth. Now, going into this year, they actually predicted growth to be flat. So they've kind of slowly upped this now, and there's no appreciation in the price, which is kind of like, the disconnect going on between the share price and the company. And as well, going into next year, you can see the company is predicting a 5% growth. Now, once again, this sales growth was only a couple of weeks ago, was 3%. So once again, analysts are now starting to upgrade their prediction on this company. The company that was supposed to not be able to grow because it had too hard comparisons to beat, and also it was only a CV stock. Now analysts are starting to upgrade their forecasts and go, okay, maybe it has more growth than what we actually think. And at some point that's going to be reflected in the share price as well, because analysts are upgrading what they think it's going to grow at. But that's made no change to the share price. 90% of 5% growth. If we just kind of flick back here to the actual share price, you can see that the share price has no reflection in that. It just keeps going down and down and down. And my view is in the next kind of few months, people realise, oh, this isn't just a CV stock. This is a great company in a fast growing sector. And when that revenue growth keeps putting in good, 10, 20% revenue growth, people realise, oh, this is still growing. It just hasn't benefited from the CV situation. As well, when they realise, oh, it's a 17p ratio, it shouldn't be trading down here as well. I think it's massively undervalued on the current price it is, and then you don't factor in the growth either. I think this is, like I said, I think the downside on this one is very limited and the upside is quite a bit. So yeah, Corsair is definitely one at the moment that I am liking to make a big position. Number 2 is HIMS. So this is my new stock. I've not really bought a new stock for a good couple of months, but yeah, I think it was last week I started making a new position, and I started making a new position in HIMS. So I have started to build this position up. It's starting to get quite nicely built, but obviously I want to kind of do that over a 6 to 12 month period. I'm not going to lie, I have been quite aggressively buying this one at the moment, because I do feel like while it's in this low $8 range, and even if it pushes into that $7 range, I think that's a really tempting price to be buying at. And yeah, I'm slowly starting to build my position in HIMS. And last week, once again, I've just bought a bit more to average into that position. So I would say this has a little bit more risk than a Corsair because it is an unprofitable company. But I am liking it at these sort of prices, and I do feel like if HIMS wanted to be a profitable company right now, they could probably be profitable. Now I do have a full video of this company on my YouTube channel, which is about 25 minutes long, I think it is. So definitely go watch that out if you want more information on what I'm going to give you here. But basically HIMS was a stock that came onto the stock market about a year ago. It came through a SPAC stock, and then what happened is it shot all the way up to $24. Since then, it's been ugly. The stock has been downtrending. And yeah, it was one that was on my watch list. Never bought it because I thought the valuation was a bit too much. And I was looking at T-Doc thinking, I think this is probably the better opportunity. But since then, what has happened? HIMS has gone from about $14, $15. It's gone all the way down to $8. And now I look at that one and thinking, it could easily be like a 5 billion plus market cap company in the next kind of 2 to 5 years. The CEO has actually come out and said that his actual ambition is to get this to a 20 billion company, which would be absolutely amazing. But obviously that's that's his opinion and not my opinion. But it's good to see that he has got that kind of ambition there. Now, obviously it came through a SPAC. It's pretty much below or just slightly level with when it came onto the stock market a year ago. But the financials they put on it over the last 12 months have been absolutely amazing. And I feel like that I'm getting a company valued at the same it was 12 months ago, even though it's just grown revenue at 70% is a really good deal in my opinion. The company is still founder-led by Andrew Dudham. It was actually founded in November 2017. So yeah, this company is actually, you can see here, the revenue is 148 million. That's through 2020. So obviously we're nearly through 2021, and they're going to put around, I think it's 250 million revenue. So yeah, to get from November 2017, only 4 years down the line, to be going to nearly 250 million revenue is fantastic. And yeah, we are a CEO and founder-led company. What really kind of pushed me over the line to have another look into it was their recent earnings. The recent earnings came out on August 11th, and the EPS was not too bad. They're not burning through too much money. And like I said before, I think if they really wanted to, they could be profitable, but they'd rather put that money into growth, which I'm absolutely fine with. And the revenue was very fantastic. They grew at nearly 70% year over year and beat expectations. Now, what hims and hers tend to do is they tend to like sandbag numbers and go, oh yeah, we're only growing at 30%. And then they obviously over deliver, which is fantastic. And I think they'll probably do the same in 2022. But at the moment, yeah, the forecast to probably do, I think it was 30% this year, and obviously they're doing 70%, which is amazing. And even when they came onto the stock market through the SPAC, they're actually beating their SPAC numbers that they put in their presentation, which is fantastic. Now you can see the fantastic revenue growth here, and like I said, they're burning through a bit of money here, but I'm absolutely fine with it because where they are spending it, I am happy with. And like I said, I think if they wanted to be profitable, they could, but then at the same time, they won't grow 70%. And the big thing right now is, while the telehealth service or the sector's growing huge, take that market share for sure. So I'm all happy from that point of view. And the thing as well with hims and hers, they've got a really good balance sheet. There's no debt on there, 317 million on cash. This company is 1.5 billion, so to have 317 million in cash is pretty good going. And as well, like I said, the company is founder-led, and also the founder has 9.6% of the company and is the largest shareholder as well, which is very good to see a lot of skin in the game. So number 2 is hims, and like I said, I'm going to try build that position up in the next kind of 3, 6, maybe 12 months. And yeah, just bought a bit more into that position and building that one up for a new company in my portfolio. And number 3 is Planet 13. I've not bought this one for a few weeks, but now the company's kind of drifting into that $4 range. I was down about 20% on the position, which is one of the positions that I'm down on the most in the stock market portfolio at the moment. So yeah, I took the chance to kind of average down on this one. Without doubt, Planet 13 is definitely the more higher risk one on this list, but still, I think it's got a lot of upside. So Planet 13 is a bit more my Mary Jane play in here. Obviously the MJ space is going to grow huge in the next few years as it's allowed more and more. And Planet 13 is my little play in this area. So I've been building my position just about the mid $5 range, and obviously as you can see here, we have dropped a little bit over the last kind of week or a couple of weeks off after earnings, which were actually really fantastic. But I'm a big fan of Planet 13. I think it will be a 5 billion plus company in the next few years as it opens up more and more superstores. And like I said, yeah, it dropped off there. It's really just been on a bit of a downtrend since earnings. And for me, earnings were actually really impressive. So to have a drop off earnings that were really good, I'm just like, yep, fine, you just keep dropping, I'll just keep buying. And just to kind of show you that is that at the moment, Planet 13 isn't losing that much money as well, but what they've just done is they have just grown revenue at 204% year over year. Now, obviously, they have had the CV situation affect them because they have physical locations where they sell their MJ, and because of that, they're in a lot of tourist hotspots. But even then, back in 12 months ago, they were still growing revenue at a decent rate. So yeah, that little bit more tourism happening has pushed this revenue growth up absolutely huge. So yeah, you got a company here that it's a little bit high risk because of the area that it's in, but it's not burning through a lot of money, and as well as that, it's going to open more and more superstores. And look at that revenue growth, really, really good. So just from here, you can see the past growth was fantastic. You see the little drop off because of the CV situation, but even then, it's not really that much. And you can just see the revenue growth here. It's been fantastic, and you can see like they normally burn through like about 6 million-ish, but the revenue just keeps going up and up and up and up and up. And like I said, it's realistically, it's only burning through 6 million here with fantastic revenue growth. I think they're very close to profitability. I think we'll see this company do profitability very, very soon. So yeah, that's all very good with the revenue growth and the money they are burning through. And financial health wise, there's not much down there on the balance sheet, and it's just about 1 billion market cap company, and it's got 136 million in cash. So yeah, I mean they've got very healthy amounts of cash. I said before, they're burning through about 6 million-ish. So that's no problem at all when they've got this amount of cash that they do have in the company. As well as that, within inside the company, there is a massive amounts of shareholding, and the positions have been increased a huge amount. Look at the positions they're increasing here, the top shareholders, and you can see here the co-CEO and co-chairman owns 19%. and you can see here the other co-CEO and the other co-chairman owns 90.62% as well, which is really good, as well as some other little insiders holding here overall. So number 3 was Planet 13. Like I said, this is probably the more higher risk stock on this list because it is in that bit more of a risky growth area, I guess, with a bit more, could regulation change a little bit, but still, even though I class it as a spec stock, it isn't too risky. But yeah, it is probably the one that I'm keeping a bit of a small position on, but I still think it'll do fantastic. So yeah, a bit of a mixture of stocks here, as you can see, but all 3 of them I'm a big fan of at the moment. So yeah, hope you enjoyed the video. I'd be interested to know if you're buying any of these 3 or which stocks you're buying. As always, hit the like button if you're new and you found this video helpful. Subscribe, and I'll see you in the next video.